This is the Accounting 5210 Spring 2016 exam review for midterm number 1. So before we get to reviewing the assignment, let's just talk a little bit about the topics that you can expect to see on the exam, and I don't think it'll be a huge surprise to see that we covered most of them in the assignment. And so the exam topics start with what we talked about in the first part of the semester. We had talked about what is a product cost versus what is a period cost, knowing what costs need to be assigned to the product and which costs will actually be expensed when we incur them. The cost flow, knowing how costs flow from basically materials into work in process, from work in process to finished goods, into cost of goods sold, knowing what cost of goods manufactured is, knowing how to calculate cost of goods manufactured, that is the cost of all goods completed during the period. And then cost behavior, knowing the definition of a variable cost versus a fixed cost versus a mixed cost, knowing the characteristics of that. For example, that variable cost per unit will stay the same over the relevant range. Fixed cost in total will stay the same over the relevant range, and a mixed cost includes both a variable and a fixed portion. Then using cost estimation functions to actually take a mixed cost and separate it into its fixed and variable portions. We used high-low method, and we also used regression, being able to interpret a regression output, estimating costs and building confidence intervals. You will not have to calculating the statistics from the regression. You'll just be given an output and knowing which statistics are important in our setting. And cost, volume, profit, being able to take a data set and either calculating break-even or desired profit, calculating margin of safety, knowing what that means, operating leverage, knowing what that means in terms of the cost structure of the company, and then being able to do an analysis in a multiple product setting. Also, knowing the pieces of the cost, volume, profit model and being able to manipulate and find maybe a missing amount given the other amounts. Then cost assignment, understanding the difference between direct tracing, driver tracing, and allocation, and understanding the accuracy implications of each. Normal costing, we talked about overhead, and in normal costing, assigning actual materials, actual labor, and then an applied amount of overhead, and we get that applied amount of overhead calculating a predetermined overhead rate. Because that's an estimate at the end of the period, we'll have an overhead variance. Knowing how to prorate that variance or dispose of that variance at the end of the period to ensure that our actual costs are on our financial statements. Then we talked about product costing. We talked about two different types of product costing: traditional product costing and activity-based costing. And so with traditional costing will determine the predetermined overhead rate based on unit level drivers, and remember, unit level drivers are those drivers associated with production. So as production increases, those activity drivers will also increase. And activity-based costing, knowing that we first determine what the activities are, determine the cost of the activities, and then using drivers associated with those activities, assign the costs of the activities to the cost object, in most cases the product. And then allocating support department costs, the departments that actually support the producing departments. And so the two methods that we went over in class are the direct and the step method. And then knowing, after I allocate the support department costs, knowing how to take that information with other information about the departments and calculating an overhead rate. Then job order costing, being able to determine the cost of a job, knowing if I have multiple jobs, how to determine which jobs are included in ending work in process, ending finished goods, which jobs are in cost of goods sold, being able to calculate the cost of goods manufactured, again, all jobs completed during the period, and then being able, on a very basic level, to do the journal entries for materials requisition, for labor, for overhead, and then transfer of cost from work in process to finished goods, and from finished goods to cost of goods sold. Here is the front page of the exam, and so this is exactly what you'll see when you come in to take the exam. And so you have 8 multiple choice questions, which are typically just conceptual in nature. You might have a few minor calculations in there. So 8 multiple choice questions, 3 short problems. The short problems are, I describe a short problem as a data set, and I'll ask you one question on that data set, and those short problems could come from any of the material that we covered. And then 3 longer problems, which is a data set, and you might have multiple questions on the same data set. So I usually give you an idea of what those problems would entail. These 3 problems, I can tell you that one of the problems is cost, volume, profit. One of them is product costing, job order costing, and one of them is cost behavior. So that gives you an idea of what the 3 longer problems could entail. So let's go over the review assignment, and basically I'm just going to talk you through the solution on most of these problems. And so it's very important that if you don't understand the solution as I present it, to contact me. Just send me an email and let me know that I need to help you understand it a little bit better. So again, we're just going to go through this question by question, and I'll just talk you through the solution. So the first question is basically a high-low problem, taking the information we have and determining the fixed and variable portions of a mixed cost. And so what you see here is you have this company has presented 2 different levels of production. And so we want to know, in the first question, the best estimate of total monthly fixed manufacturing cost. Well, if you look at materials and labor and you do some calculations there, and even by definition, materials and labor those are both true variable costs. So the only cost we're really looking for in terms of fixed costs is the manufacturing overhead. So it's going to be the fixed portion of manufacturing overhead that answers this question. So for the high-low method, what we do is we determine the high point and the low point. We only have 2 points here, so the high point is the 8,000 and the low point is the 7,000 units. And so to get the variable cost per unit, you just take the change in the cost over the change in the activity, and the activity in this case is production. And so you have the change, again, change in the cost over the change in the activity, and this gives you your variable cost per unit. So if you think about that equation, y equals f plus vx, we have to use this now to get the fixed portion. So we know y, and you can use any one of the y's. This is a y, this is a y, and then the variable cost is going to be the production times the variable cost per unit. And so I've chosen to use the 8,000 unit point, the high point, the 684,800 and the 8,000 units. You can also use the 7,000 units and you get the same answer. If you use the 7,000, it would just be 670,300 equals the 1450 times 7,000 plus f, and solve that for f, and again you get the same answer. So f is 568,800, and that was the answer. So then the next question is, we want to know the best estimate of the total variable manufacturing cost per unit. So the variable manufacturing cost per unit now includes not only that variable portion of overhead that we had before the 1450, but now we determine the materials, the labor, and the overhead. And so again, you could have used either the 8,000 production level 8,000 or 7,000 to determine these amounts. And so direct materials per unit is $15.10, taking the total cost divided by production. Same with the labor, and then adding the 1450 we just determined. So the total variable manufacturing cost per unit is $72.10. Alright, question number 3. This is a problem that really kind of falls in the cost volume profit area. And so we have a company that's currently selling 140,000 units. The selling price is 30, variable costs are 18. So they need to decide whether or not they want to spend $65,000 on advertising if the sales volume will increase by 5%. And so everything else remaining the same, what would be the result? So if we have an increase in sales volume, then we're taking the 140,000 and increasing it by 5%. So really what we're talking about is an additional 7,000 units. So these 7,000 units, you kind of have to think about what are we getting versus what are we paying. And so what are we getting? We're getting an additional $30 per unit in sales price for each of these 7,000 units, but we're also paying an additional $18 per unit in variable cost. And so really, we can look at it in terms of what is our additional contribution margin. And so our additional contribution margin is 84,000. Well, and then what we spend is 65,000. And so for this question, we increase contribution margin by 84,000, but we increase fixed cost by 65,000, so it's an overall increase in operating income of 19,000. There's a lot of different ways to get to this answer. This is probably the most efficient. But again, if you got to the same answer using a different logic, then you're totally fine. Okay, this is question number 4. This is just determining what is the cost of all goods completed, which the cost of all goods completed, that is just cost of goods manufactured. And so cost of goods manufactured, we know we can get from either the work in process T account or the finished goods T account. But to do the work in process T account, you would need to know all of your manufacturing costs. So it looks like we really have to work with the finished goods T account. And finished goods beginning of February is 35,000. Finished goods at the end of February is 27,500. We know that cost of goods sold was 67,000, so we know that that is a credit, and the only addition to the finished goods is going to be cost of goods manufactured. And if you solve that T account, cost of goods manufactured has to be 59,500. And I drew a T account, but you can see that from the formula it's the same thing, getting to cost of goods manufactured. Alright, question number 5. This question, you're going to have to think a little bit backwards here. It says that you incurred 114,600 in actual manufacturing cost, and we have a predetermined overhead rate of $6 per direct labor hour. At the end of the period, the manufacturing overhead account has a credit balance of 7,200. And so if we just stop right there for a second and think about this manufacturing overhead account, it has a credit balance of 7,200. Well, what does that mean? If I have a credit balance in my manufacturing overhead account, this means that I am over-applied. And so I'm over-applied, and so I can look at my actual amount of overhead going into the account. This is actual. Then this is the applied amount has to be 114,600 plus 7,200. So the applied amount is 121,800. So that's the total applied amount. Well, I know that applied overhead is equal to the direct labor hours times the $6 overhead rate. And so if I divide 121,800 by 6, I get the total number of direct labor hours that were worked. And so we'll see the solution on the next slide here. And so the total amount of direct labor hours worked is the 20,300. So in question 6, we have a cost volume profit problem again. And so we have a situation where a company knows that if it sells 500,000 units, it has an after-tax profit of 60,125. And so we know the fixed costs are 817,500, variable costs are 65% of the selling price, and the tax rate is 35%. So what we're looking for is the selling price per unit. So really, whatever is not known or whatever we don't know, we can let that be X. And so if that is the selling price per unit, then 65% of that is the variable cost per unit. And if we have an after-tax profit of 60,125, our before-tax profit is going to be 60,125 divided by 1 minus the tax rate. And so our before-tax profit, calculate that out, is 92,500. Now we can go to our operating income equation. And our operating income equation says that our before-tax profit of 92,500 is going to be equal to sales of 500,000 units. So if I take X times 500,000 units minus our variable cost, which is 0.65x times 500,000 units, minus the fixed costs of 817,500, then we have our operating income equation. And if we solve this for X, it gives us our answer of $5.20 per unit. So always remember that you can use that operating income equation, and you can pretty much solve just about any cost volume profit problem that we have. And so you'll see on the slides that you actually have this solution. Alright, question number 7 and question number 8 is a service department allocation. So we have a company that has 2 service departments and 2 producing departments. And so what we're trying to do is take the total costs of the support departments, which the the custodial department has $40,000 and the human resource department has $6,000. So number 7 is using the direct method, and number 8 is using the step method. And so let's go and solve number 7 first. And so we have custodial, let me go back. If we have custodial, human resource, Department A, and Department B, we can actually allocate these costs. So we know that the custodial department starts with 40,000. The human resource department starts with, let's see here, 6,000. And our overhead costs in Department A and Department B right now is 8,000 and 20,000. So under the direct method, we don't care if custodial is providing services to human resources or human resource department is providing services to custodial. So we'll take the cost in each of these departments and directly allocate it to A and B. So if we look at custodial, custodial actually allocates their cost based on the basis of machine hours. So we just need to look at the number of machine hours for the departments that we're allocating this cost to. So Department A has 630 machine hours, and Department B has 270 machine hours. And so that is a total of 900. So there are the ratios that we will use to allocate the 40,000. And so if I take that, the amount of the custodial actually assigned or allocated to Department B is 12,000, and the remainder is allocated to Department A. So this is 28,000. And so then after we allocate that, there's a zero balance, and then we allocate the Human Resource Department. The Human Resource Department is allocated based on the number of employees, so we look at the number of employees in Department A and Department B. We have 200, so total of 400. So half will be allocated to Department A, and half will be allocated to Department B. So again, after allocating, these two departments have no cost left in them. And then the question asks, what is the total overhead cost of Department B after we've allocated everything? So we add up the 20,000, 12,000, and the 3,000 to get a total of 35,000, and that was the answer in number 7. So again, you do have the solution here. Percentage is slightly different, just a more efficient way to get to the answer. Excuse me. So then in 8, what we have is the same problem, except now we want to allocate it using the step method. And so they allocate the cost of custodial first. So I'll put that in its order. So custodial, human resources will be allocated next, and those will be allocated Department A and Department B. So again, custodial starts with a cost of 40,000. I didn't leave myself very much room here. So the custodial will be allocated out of custodial into human resource Department A and Department B. And again, that's based on machine hours. So now we need to know the machine hours in human resources, in Department A, and Department B. And so our ratio now is over 1,000. So 10%, 63%, and 27%. So human resource will get 10% of that, or 4,000. Let me get my calculator. Department A will get 25,200, and Department B will get 10,800. And remembering that I start with a cost of 8,000 and 20,000. I forgot to put those in. And a human resource starts with a cost of 6,000. So now we go to allocate human resource. So again, we have nothing left in custodial, and under the step method we do not allocate anything back to it. So now we have to think about what is the total cost in human resources, and so we allocate the 10,000 out, and this is based on number of employees again. So I have 200 employees in each of the departments, so they each get half, so 5,000 to Department A and 5,000 to Department B. So the total cost, again, the question was asking for the total cost in Department B after allocating using the step method. I add up all three of these numbers and I get 35,800. That's a 0. And so that was the answer to number 8. And again, just the same solution, just presented a different way. Alright, here's an extra question. Now, assume that we're going to use the step method, and we assume we allocate human resource first. If Department B assigns overhead based on direct labor hours, what is the overhead rate for Department B? And so we can, this is the step method. Again, now we're just switching which departments actually are being allocated. And so if we allocate human resource first, you notice that this, in this presentation, this was the amount of cost in human resource. We're allocating it based on number of employees. And so the number of employees would be 120 for custodial, 200, and 200 for each of the departments. So that's where you get the 520. So for Department B, you can just think about they're getting 200 out of the 520. And then custodial starts with the 40,000. This is the allocation that they are receiving from human resource by having 120 of the 520 total employees. And then this total cost, after I add the 40,000, is allocated based on machine hours. And so the machine hours is the 630 and the 270. So Department B gets 270 out of the 900. And so that gives you your total cost. So your total cost is the 34,723.07, and it asks for the overhead rate. So you should be able to take the next step here, and if the overhead rate, it says it's based on direct labor hours, we look at direct labor hours only for Department B, and so that comes down to our calculation, and so our overhead rate is 138.89 per direct labor hour. So you should be able to get all the way down to this type of a calculation given support departments and allocating support department costs. Alright, question number 9. This is asking for the operating income or loss for the month of November. You're given a lot of information here. So you're given information about sales, you have some inventory balances, some labor, and some overhead. And so remember that your operating income is going to be sales minus cost of goods sold minus your S&A costs, and so that's going to be operating income. So we know what sales is, so our biggest challenge now is to determine what cost of goods sold is. So let's determine what cost of goods sold is. Well, let me go back. So cost of goods sold, draw some T accounts here. So cost of goods sold is going to be the amount coming out of finished goods. So this will be cost of goods sold. So what do we know about finished goods? Finished goods at the beginning was 133,000. Finished goods at the end of November was 113,700, but that's all we know. And so we know this has to be cost of goods manufactured. This is cost of goods sold. And so we don't know what cost of goods manufactured is, so we look at work in process. Work in process at the beginning is 37,500. Work in process at the end is 86,000. And so if we can determine this number, we can put it into our finished goods T account. But we don't know what's been added, so we need to know direct materials, direct labor, and overhead. Well, we know direct labor, that's 225, 400, getting a little bit, didn't give myself very much room. Factory overhead, 203, 900. but we don't know direct materials, so now we have to go back to direct materials inventory. So we know that this amount that would be the credit has to be the debit to work in process for materials. And so materials at the beginning is 25,300. Materials at the end is 19,500. And we know that material purchases was 195. It's getting a little crunched there, but you can see, hopefully see what I'm doing. So materials here, direct materials has to be 200,800. So that's the number that goes into our work in process T account. So 37,500 plus 200,800 direct materials used, 225,400 direct labor incurred, 203,900 overhead applied, minus cost of goods manufactured has to equal 86,000. And so cost of goods manufactured ends up being 581,600. So that goes into our finished goods T account, which means cost of goods sold ends up being 600,900. So we're going to use that information see if I can. So now we have sales. Sales is 950,350. We just determined cost of goods sold, which was 600,900 minus our selling and administrative, which is 165,000. So operating income has to be 184,450. Alright, and again you see that solved without the T accounts in the next slide. Alright, question number 10. This is if targeted sales is 318,000, contribution margin ratio is 0.4, and their after-tax net income is 33,475, then what are total fixed costs? And again, we can use our operating income equation, except we need to take that after-tax. We have to take that after-tax, get my pin here, that after-tax and convert it to before-tax profit. So the 33,475 has to be expressed as a before-tax profit. So my before-tax profit turns out to be 51,500. This problem is similar to what we did before, and so that's not very good. Let me make that better. So again, our operating income equation, we know that our before-tax profit is 51,500. Our targeted sales is 318. If our contribution margin ratio is 4.4%, then our variable cost ratio is 0.6%, and so that minus fixed cost. The only thing we don't know is fixed cost. So if I solve this equation for fixed cost, I should get fixed costs of 75,700. And that's the answer to that one. And again, here's the solution that you see on the slide. So if we go on to question number 11. Question number 11, if you think about it, it's a little bit tricky. It's asking you what the company's operating leverage is. So if you think about what operating leverage is the company's contribution margin over a certain operating income, and so we want to know what their operating leverage is when they have a margin of safety of 115,000. So remember, the margin of safety is how far above break-even we're actually operating, and so what we have to determine is what break-even is. What is the break-even sales level? So if we let X be the break-even dollars, then in our operating income equation, we have 0 operating income for break-even is X, which is the sales revenue, minus the variable cost, which is 30% of X, minus their fixed costs of $315,000. So we can actually determine what break-even sales are. So if we do this calculation, break-even sales is $450,000. Well, if break-even sales is $457,000, then what is their current level of sales? If they're operating at $115,000 above break-even, then their current level of sales is $450,000 plus $115,000. Yeah. And so total current sales has to be, has to be $565,000. And so if we know current level of sales, then we can determine contribution margin and operating income. So the contribution margin, so our current sales is equal to $565,000. Variable costs are 30% of that. Let's see what that is. Variable costs are $169,500, which means that the contribution margin is equal to $395,500. That's one of the inputs we need, and then we subtract fixed costs of $315 to get operating income, and operating income is $80,500. So then we can determine that operating leverage is $395,500 divided by 80,500. So our operating leverage turns out to be 4.91. And so you'll see that on the next slide. I know it's easier for me to talk you through the problem if I'm actually writing it out, so I know this is redundant. Alright, and you have these slides. You can go through them at your own pace. They'll be posted on Canvas. Alright, question number 12. Question number 12 is asking you what's the total manufacturing overhead cost listed above for March. And so you have to know what are the indirect product costs listed in this list here. So corporate headquarters building rent is not a product cost. Factory depreciation, that will be one of the manufacturing overhead costs or indirect product costs. Admin wages and salaries is not. Direct materials is not part of overhead, is a product cost, but it's a direct cost. Sales staff salaries, that is not a product cost, that is a selling cost. Factory supplies is factory overhead. That's used in the production of the products. Advertising is a selling cost. Factory supervisor salary is overhead. So your overhead amounts are, the total overhead is the $55,000 plus $6,700 plus $39,000. So that all equals 100, 700, and actually this is the one answer where this is actually H, none of the above. So you'll see that on the. Alright, questions number 13 and 14. This has to do with product costing and costing in a traditional costing system and costing in an activity-based costing system. And so remember that under traditional costing, we assign overhead based on unit level drivers, and the company's actually chosen, if they were to use a traditional costing system, they're going to use the direct labor hours. So what you'll notice here is this is the driver that will be used in the traditional costing overhead assignment, and we will add all of these costs together to get total overhead. So the total amount of overhead that's going to be assigned under either method, the total of this is $340,000. And so in traditional costing, let's see what we have on the next screen. So in traditional costing, we determine what the overhead rate is. And so the overhead rate is that total $340,000 in overhead divided by the total number of direct labor hours that they expect, and that's 5,000 direct labor hours. So your overhead rate turns out to be $68 per direct labor hour. Then we look at job 52, and the question says, what is the total cost of job 52? So we have to include direct materials, direct labor, and overhead. And so if you see direct materials is $2,575 for job 52, direct labor is $2,100, and then overhead's going to be $68 times the number of labor hours, which for job number 52 is 75. So if I take 68, multiply it times 75, I get 5,100 in overhead for job 52. So I add all three of those together, and get Alright, so for question 13 again, going through adding direct materials, direct labor, and overhead, we get a total of, on the job 52, of 9,775, again overhead being assigned based on direct labor hours. And you'll just see that this again, just going through and showing you the answer again in a different way. So we can actually do the same for job 53, except I made a mistake. This isn't 6,120. This is actually, let me correct my slide here, I'll have to go back and fix it. But actually, if you look at the direct labor hours, this should be 110 times 68. So this is 7,000. Let's see, where do I want to put it? 7,480, and so the total is 13,590. And so you can check yourself, and you can actually do a problem for job 53 also. So again, these, oops, let me go back. Again, we just fixed these, so just know that this is 13,590. So if you want to think about it, how will activity-based costing affect this cost assignment? So if you look at the activities in the problem, you have moving materials, inspections, ordering, and maintenance. So you look at the drivers. Again, we kind of talked about this in class. Which of those drivers associated with those activities are unit level and which ones are non-unit level? And so you see that there's only one unit level driver, and that's machine hours. And so under traditional, notice that we used direct labor hours, which is associated with production. Machine hours is also associated with production. So if we're using a unit level driver to assign the cost of the non-unit level activities, then we're going to have some cost distortion. And so really, if we think about it, that phenomenon that we're going to have is that the higher volume product is going to be overcosted, and the lower volume product is going to be undercosted. So we would expect that under activity-based costing, some of this cost shifts to job 52 because that is the lower volume. And again, this is based on the assumption that our lower volume product is going to be a little bit more complex and actually use more of our overhead resources. So let's look at activity-based costing. And so if you look at the problem, you can see that we've identified the driver. This is a number of moves, and so this is moves, this is hours, inspection hours, this is orders, and this is machine hours, again, this being the only unit level driver. So we divide the cost by the driver and we get our activity-based costing rates. So again, we're asked for one of the jobs, so job number 53. Again, the total cost, so we have to add direct materials, direct labor. Direct materials for job 53 is 2,810. Direct materials is 3,300. And then our overhead. So we're going to have 4 activities, so we're going to have overhead assigned out of those 4 activities. So moving materials, we're going to have $105 per move, and job number 53 has 5 moves. And then inspection, we have $21 per inspection, and we have inspection hour, and we have 4 inspection hours. Ordering, 59.30 times the number of orders. Job 53 has 20 orders. And then we have maintenance, which is $32 per machine hour, and maintenance has 90 machine hours. So again, I'm going to show you the next slide. So this is really taking that and multiplying out what we just did. Again, you can see this is 105, 21, 59, 30, and 32. So this is our total overhead assigned to job 53. And so total overhead, or total job cost then, is $10,785. Which, remember what it was before. This is activity-based costing. Under traditional, it was $13,590. So some of the cost did shift to job number 52. Yeah, that should say job number 52. I have to fix that too. Again, job number 52. And actually, it's, as it turns out, in both of these jobs, because they're not the only 2 jobs in the factory, both of the jobs actually turned out to be a lower cost. Again, this is because we probably have other jobs in the factory that are consuming a higher proportion of that overhead. All right, number 15. Right, so number 15 is a multiple product cost volume profit problem. And again, you can do this a lot of different ways. I will show you, well, I'll show you all of them. It doesn't really matter. And so let's look at and see what we have here. One of the things you have to notice that this is not the sales price. This is the variable cost per unit. So I need to determine the sales price for product A and product B. So if the variable cost per unit is $24, contribution margin ratio is 40%, then I can determine what the variable cost percentage is. The variable cost percentage for product A is 60%, and for product B 80%. And if the variable cost per unit is 24 and 40, then I can just take and get the selling price is going to be equal to 24 divided by 0.6 and 40 divided by 0.8. So let me see what that is. So the sales price per unit for product A turns out to be 40, and for product B it turns out to be 50. So if the sales price is 40 and 50, then we can determine what our contribution margin is. I can either take it times the ratio or subtract the variable cost per unit, and so I get a 16 contribution margin per unit for product A and a $10 contribution margin per unit for product B. So probably the easiest one to do first is to look at the baskets. And so we need to know what our sales mix is. And it looks like we have 2 units for every 1 unit of B. So if we look at our sales mix, we have 2 to 1. And so we have a $32 contribution margin per basket for product A, plus a $10 contribution margin per basket for product B. So our total contribution margin per basket is $42. Again, that's per basket. And so baskets, we go 0, which is break even, equals our $42 per basket minus our fixed cost. So how many baskets do we need? We need, except I apologize, I forgot that we wanted an after-tax income of $73,500. So really, that's not 0. This is $73,500 divided by 1 minus the tax rate. And so really, let's back up here. Really what we have is that turns out to be 105,000 equals 42x minus 840,000. I apologize. So the number of baskets to achieve this after-tax income, the number of baskets is 22,500 baskets. So 22,500 baskets. How many products does that relate to in terms of product A and product B? How many product A's are in a basket? Well, I have 2. And how many product B's are in a basket? I have 1. So that means I have 45,000 units of product A and 22,500 units of product B, and that is the answer. So if I use contribution margin per unit, and actually this has to be a weighted average contribution margin per unit, then remember our contribution margin per unit for product A was 16, and so let's see, A and B, so it was 16 contribution margin per unit, and again it was 2 to 1, so I had 32 plus 10 is total contribution margin of 42, and that's what we had before. But now, in order to use contribution margin per unit, we're going to divide that. We're going to divide that by the number of products. And so in our basket we have 3 products. So if we want to do a contribution margin per unit, weighted average, then this turns out to be $14 per unit. I'm getting kind of messy. So, weighted average contribution margin per unit is $14. So again, I use our desired before tax is equal to $14 times the number of units minus 840,000. So total number of units using the weighted average contribution margin per unit is 67,500. So how do I break that apart between product A and product B? 67,000, and this is units, 500 units. So what proportion of those is product A? Well, 2/3, and 1/3 is product B, and so again I get the same 45,000 units and 22,500 units. So that's the weighted average contribution margin per unit. What about the weighted average contribution margin ratio? Well, my total contribution margin, remember, was 42. I just need to know what total sales is. And remember, our sales price for product A was 40, and our sales price for product B was 50. I sell 2 to 1, and so I have 80 plus 50, so that's 130. And so our contribution margin on a weighted average basis ratio is equal to our contribution margin divided by our total sales. And again, you could use any number of units as long as it was 2 to 1. So our weighted average contribution margin is a little bit messy, but it's 0.323, about 3231. So then, to get our total sales that we need, 105,000.3231x, that's our total sales, or total contribution margin in dollars, minus 840,000. And roughly, if you do this, let me see what exactly it is. I know if you hold the number in your calculator, you're going to get exactly, but let me calculate based on how we rounded it. If you round it, you get 2,924,791. If you hold that entire number in your calculator, you're going to get an even 2,925,000. But for A and B, now I need to take 2,924,791, 2,924,791. Now I need to, what proportion of that total revenue is A and B. So remember, the total amount of revenue in a batch of products, 3 products that go out, was 80 for product A and 50 for product B. A total revenue of 130 for 3 products. So you can see that your total revenue, let me calculate that out because I didn't round it. So 1,799,871. That's total sales revenue. And then 292. This is 1,124,000. About 920. So to get the number of units, take the 1,799,871 and the 1,124,920, and we divide it by the sales price. So for A and B, for A we had 1,799,871. I divide that by the selling price, 40, and 1,124,920 divided by a selling price of 50 to get the number of units. So let's see what we get. 1,799,871. We should get really close, and we do. 44,997. And on the exam, I'll be able to tell if you rounded, so I wouldn't worry too much about rounding the wrong way on this. Although rounding it to 4 decimal places is usually a pretty good idea. So 22,495. $1,298, and these are units. So either way, it gets you to the same, pretty much the same answer, so you can decide which way you want to do it. You do not have to know all three, so don't worry about knowing all three ways. Alright, the other things that you may want to know if you're presented with this type of problem is you should be able to answer a question about margin of safety. What is the margin of safety based on the units? So what we're doing here is margin of safety in units. And so the expected sales level, oh gosh, do I give that to you? So let's say the expected sales level, remember, in total is the 67,500. So what you need to do is you need to be able to know what break-even level of sales is. And so the break-even level of sales is 60,000 units, which you have to calculate. I'm not sure why I have this here, but you can actually determine that if you do your contribution margin per unit, or however you want to do it. You can calculate break-even sales. Our weighted average contribution margin per unit was, I believe, 14. Let me make sure. So our weighted average contribution margin per unit was 14, so 14x minus 840. And your x right here turns out to be the 60,000. So I kind of jumped the gun a little bit. You should be able to determine what this break-even level is, and then your margin of safety is just going to be the difference. So just be aware that you should be able to calculate what the margin of safety is. Alright, now I probably have... So you should be able to, again, now, in addition to margin of safety, be able to calculate the operating leverage. And we did this in another problem on this review. So that's equal to contribution margin divided by operating income. And actually, you know what operating income is. Operating income is 105,000. And we know what contribution margin is because the contribution margin is going to be the weighted average contribution margin per unit times the 67,500. So I take 14 times 67,500. I know that the total contribution margin is 945. So I know the operating leverage is 9. So that's 5,000 was our operating income. Oops, went too far. And so you can see again, here's our contribution margin, what we just calculated on the other side. So what does a high operating leverage indicate? High operating leverage means that the company is taking on a bit of risk because they have a higher level of fixed costs they have to cover. So a higher level of fixed costs means that once they reach break even, they'll have a higher, their operating income will increase at a higher rate after break even. And so this just tells us about our cost structure. It's a higher level of fixed costs is assumed to be a little bit riskier because of that fact, because if demand goes down, then it can go down, and if it goes down far enough, I still have to cover my fixed costs. If I have a lower level of fixed costs, then it's less risky. Alright, questions number 16 and 17. So this is cost behavior, looking at these two separate regressions, trying to determine what is the best estimate of our costs here. And the cost that we're trying to estimate is the cost of training for this company. And so you were asked to determine which was the best cost driver. And so really, if you're looking at the best cost driver, you're looking for the cost driver that helps explain most of the changes in the costs that we're trying to estimate. And so really, you're looking at the difference between the R square and really the the rest of the statistics should really back up what you have determined or what you've concluded based on this R-square. So this R-square means that 45.32% of the change in the cost of training can be explained by changes in the number of sculpting hours. And so just based on that, we would probably pick this as our best driver. And again, what backs this up, again, we can look at the other statistics. The standard error is smaller, meaning that the estimate will be more precise. Our data points are closer to the line. You can look at, here's our variable cost per sculpting hour, and look at the t-stat. The t-stat tells us how many standard errors we are away from zero, so whether or not we are statistically the same as zero. And so this means since we are more than 3 standard errors away, more than 99% of our observations are within that range, and 0 is not a possibility in there because this tells us how far 0 is away from there, so we are statistically different. And you can see how that compares to this t-stat down here. Here we wouldn't be able to make that same conclusion. Alright, so sculpting hours, this regression right here is our best driver. So what we're looking at here is our estimation equation is y equals 21.90 minus plus 1,214.35. I didn't do that very good. Y equals 2190 plus $1,214.35. Still, it's crazy. It's not a very good 3. Okay, you get the idea. Alright, so plugging in, and this is X. Plugging the information that we have, if we choose sculpting hours as our best cost driver, then what we're plugging in here for question number 16 is 12,300 sculpting hours. And this is just pointing out the statistics that we just did on the prior slide. So again, here is the estimation equation we determined on the prior slide, and plugging in again 12,300 into the equation, we get $270,584.35, which was the answer to number 15. Alright, number 17, or 16, that was answer number 17. Okay, number 17 is you are building a confidence interval, and the confidence interval, now what we're going to assume is that the company uses the number of ice blocks. So the estimation equation for the number of ice blocks, if you look back on the equation, it is $223.48 times the number of ice blocks plus $6,764.58. Yeah. Stupid stylus. Yeah. Okay, happy with that. Alright, so when we're choosing, or we're building a confidence interval, what we're trying to do is we're trying to provide a range, a bottom limit and an upper limit. That range will give us a confidence level that if I actually incur or actually use 1,300 ice blocks, that the actual cost of training will be in that range. So again, we're building a 90% confidence interval, and so what we need is we need our estimate from putting in 1,300 for X plus or minus T, which we'll get from the table, times the standard error of the estimate. So let's find Y first. Y is 223.48 times 1,300 plus $6,764.58. So our estimate is actually equal to $297,289, and I think I rounded that, but it doesn't matter. Alright, so that's Y. Now we need to find T, which this comes from the T table, and it tells us how many standard errors is going to give us the 90%. Again, kind of adjusted for our sample size. So to get T, we need to know the degrees of freedom. And again, this is our free choices after we are estimating both the intercept and the variable cost per unit. So our degrees of freedom is the number of observations that we have, 24, minus those two variables that we are estimating. So our degrees of freedom is 22. So here's where you have to go to the T table. If you go to the T table, go down or go to 22 degrees of freedom at a 90% confidence level, our T is going to be equal to 1.717. And so what that means is I go 1.717 standard errors away from this estimate, right, the 297, 289. This includes 90% of the observations, including the actual cost. Alright, so my range is going to be 297, 289. Here's my bottom range, minus 1.717 times the standard error of the entire estimate. So if you look back on your regression and looking at number of ice blocks as the driver, my standard error is 43,127. So that's the bottom end of my range. The top end of my range is 297, 289 plus 1.717 times 43,127. And so my confidence interval turns out to be 223, 240, 371, 338. And again, this tells us that if we actually incur 1,300 or use 1,300 ice blocks, that the actual cost related to using 1,300 ice blocks will be in this range. Again, remember, this is an estimate, and so we're estimating that cost. Alright, and again, you can take your time and download the slides and work through that if you want to. Alright, number 18. See if I can find it on my thing here. Yeah. Alright, so it says determine the cost of goods manufactured for the month of July. Oh, they determined the cost of goods manufactured for the month of July was $430,000. They reported the beginning work in process was $90,000, ending work in process $120,000. If total manufacturing overhead for the month was $201,250, prime costs were 75% of conversion costs. What was the amount of direct labor incurred for July? So here, what we're trying to determine is direct labor. So you're really working with your work in process T account here. So we can just put in what we know. And so cost of goods manufactured for July we know is a credit to work in process. And we know that beginning work in process is $90,000, ending work in process was $120,000, and we know that overhead added for the year or for the period was $201,250. So what we don't know are these prime costs, and we don't know labor, but we do know that prime costs were equal to 75% of conversion costs. And so we can determine what prime costs are right here through our T account. And so 90,000 plus the prime cost plus the overhead minus cost of goods manufactured is 120,000. So you find that the prime costs are actually equal to 258,750, and that's what that number is. So I know that that's equal to 0.75 times my conversion costs. So then I can find my conversion costs by taking the 258,750, dividing it by 0.75, and so my conversion costs are 345,000. I know conversion cost is direct labor plus overhead, so 345 equals direct labor plus my overhead. I always run out of room, 250. So direct labor turns out to be 143,750. Gets kind of messy. So I've just kind of walked you through that, but again, you can see this on the slides. We solve for prime costs. We did that with our T account. And then we know that those costs are 75% of conversion costs. So we take prime cost divided by the 75%, and then knowing that conversion cost is direct labor plus manufacturing overhead, we can determine what direct labor is. Alright, questions 19 and 20. Okay, this is a company that uses job order costing. It uses a predetermined overhead rate based on direct labor hours. Manufacturing overhead cost, direct labor hours were estimated 300,000 and 60,000 hours. So we're looking at job 35. So we have materials, we have labor, we know what the labor rate is, and so by the end of the year, Boxing had worked a total of 62,500 direct labor hours and had incurred 295,200 in actual manufacturing overhead costs. So what we want to do is we find the total cost of job 35, and so for job 35, we know that we had direct materials of 7,000, we had direct labor of 6,300, and so we need to know what overhead is. Well, our overhead rate is equal to the total estimated overhead divided by 60,000 hours. So our overhead rate actually turns out to be $5 per direct labor hour. And so our overhead is 5 times our direct labor hours. Except we don't know our direct labor hours, but we can determine it because our labor cost is 6,300, and the total number, or our actual labor rate, was $18. And so this gives us the fact that we had 350 direct labor hours. So 5 times 350 hours, 7,750. So our total job cost was $15,050. Alright, so overhead. Is it over-applied or under-applied? And so we know that applied overhead is the overhead rate times the actual number of hours worked. And the actual number of hours worked is 62,500. So the total amount of applied overhead for the year is 312,500. Then we compare that to actual. Actual overhead is 295,200, and so the difference between that is 17,300. And since applied is more than actual, we are over applied. And so you should be able to Make sure I have this on this. If not, we'll back up and do it. So if you can determine that the over-applied amount is 17,300, and if the overhead variance is written off to cost of goods sold, you should be able to determine what the journal entry is. And so if this is over-applied, your manufacturing overhead account has a credit balance. And so the credit balance means that, again, we have more applied overhead than actual. So we're going to debit manufacturing overhead and credit cost of goods sold for the 17,300. And you can see that there. Now, oh, let me go back. Yeah, why did it do that? Alright, now what if instead of the variance written off to cost of goods sold, what if we wanted to prorate the balance, or prorate the 17,500? If we wanted to prorate it, we would need to know ending work in process, ending finished goods, and ending cost of goods sold, which we don't know in this problem, but you could get the total of those, and you would get a relative percentage of each ending balance of the total and multiply it times the 17,300. And so, do you know how to prorate the variance into the various ending balances in the inventory and the cost of goods sold account? So the conceptual justification for prorating is that if I've overapplied, I put too much cost into my production, and which products are overcosted? Well, products that haven't been finished, products that are finished but not sold, and products that have been sold. So that's why we would prorate. So just be aware that proration is a choice in addition to just writing off the variance to cost of goods sold. Alright, well that's the end of the review. I realize it's probably not as effective as if we could have done it in class, but if you have any questions, you can certainly send me an email. I'll be in my office all day on the day of the exam, so come by if you have questions.